Have you wondered what's better, a 15-year mortgage or a 30-year mortgage? Well, we're going to look at the numbers today so you can decide what's better for you. The idea, though, is what do the numbers show? What makes the most sense financially? Take a look at this. All right, let's look at the numbers. We're going to use $500,000 for our 15-year mortgage, which is 180 months. $500,000 for our 30-year mortgage, which is 360 months. And you notice there is no interest rate that I'm using right now. It's zero. The 15-year mortgage has a payment of $2,777. The 30-year mortgage has a payment of $1,388. I'm not using an interest rate here because I simply want to show that if you paid $2,777.78 for 180 months, you would pay off the $500,000 loan. And if you paid $1,388.89 for 360 months, you would pay off the loan. There's more than just time frame when it comes to a 15-year mortgage and a 30-year mortgage. There are other things that your money could be doing, and you also have to take into consideration taxes. I'm going to start with a 5% loan rate on both loans. Now, these aren't the rates currently. Obviously, a 15-year mortgage has a different loan rate than a 30-year mortgage, but follow me on this. We want to look at the net cumulative cost of the loan. On the 15-year mortgage, it's $711,000. On the 30-year mortgage, it's $966,000. So clearly, if this were the only factor we were looking at, the 30-year mortgage does have a higher cumulative cost. But when you purchase a home, you're able to deduct the interest. And we want to look at that. So we are going to put both of these individuals in a 30% tax bracket. And now what you see is over the course of the 15-year mortgage, there's a cumulative savings of $63,000. Right? Here's the interest deduction. And over that 15-year time frame, we see the $63,514. In the 30-year mortgage, you are paying interest for a longer period of time, which is why we have a $139,000 cumulative savings. This is something to consider. Not only are you getting a larger interest deduction because of the 30-year mortgage, I want you to now think about what if you put that money to work? Rather than just taking the deduction and forgetting about it, what if you put that money to work and it were earning a 5% interest rate? So on the 15-year mortgage, we're going to do a net savings rate of 5%, and the 30-year mortgage, a net savings rate of 5%. Now take a look at this. The net compound cost of the 15-year loan is $2,013,000. The net compound cost of the 30-year mortgage is $1,852,000. The 30-year mortgage costs you less money. Why? Because you get that deduction for interest. Now, you might feel internally that a 15-year mortgage is better for you and your family. This is a personal decision. But what I'm showing here today is financially, you're better off with a 30-year mortgage. And we're going to dive into this deeper so you'll see with today's loan rates as well. Before we get into these other deeper numbers, there is one other thing. Many people want to pay cash for their home, but cash has an opportunity cost. For example, let's say you take that same $500,000 and you just pay cash for the home. What's the lost opportunity cost on the $500,000? If you could put that into an investment, earning a conservative 5% return over the 30-year time frame, that $500,000 would grow to $2,160,000. If you have money locked up in your home and you're not putting it to work, there is a lost opportunity cost. Cash isn't always the best way to make a purchase. Let's dive in deeper. Let's look at these 15-year and 30-year mortgages with today's loan rates. I pulled rates at bankrate.com. We want to focus on this section right here. The national average for a 30-year fixed mortgage is 6.23%. The average 15-year fixed mortgage is 5.58%. So 5.58, 6.23. We're going to put those numbers now into the calculator. Now what we'll see using the real numbers, coming to our net compound cost of the loan, the 15-year mortgage has a cost of $2,071,000, whereas the 30-year mortgage has a net compound cost of $2,066,000. It's still lower overall than the 15-year mortgage. And think about this. Let's say that you have two homes side by side. They're the exact same homes and they're both mortgaged with the same bank. And both of these people get into a financial hardship. And the bank's thinking about foreclosure, but they're only going to foreclose on one home. Which home are they going to foreclose on? It's going to be the 15-year mortgage. Why? Because the person with the 15-year mortgage has more equity. They've paid off the balance of the loan sooner, which means there's more equity. And you would think, man, I'm giving the bank more money. I've got a 15-year mortgage. That's more advantageous to the bank. They're going to have my loan paid off sooner. They can lend out that money later. Some of that's true, but from their financial perspective, the 15-year mortgage in a financial hardship is a better loan to go after when it comes to foreclosure. Now, we don't want this to ever happen, but the idea, we have to look at these numbers from a financial perspective. How does it benefit you financially, and how does it benefit the bank financially? At Insurance and Estates, we are proponents of helping people grow wealth and then use that money 100% tax-free to create more wealth, to buy assets, and to have a better future. Take a look at this. The payment on the 15-year mortgage is $4,106. The payment on the 30-year mortgage is $3,072. The difference is $1,034. We recommend that $1,034 be put to use in a high cash value whole life policy specifically designed to turbocharge the cash value growth of the policy. We've already concluded that the 30-year mortgage has a net compound lower cost of $2,066,000 compared to the 15-year mortgage of $2,071,000. But we're going to make the 30-year mortgage even better by putting that $1,034 per month into a high cash value policy. What I have on the screen is a high cash value whole life illustration with a $1,034 month premium going into the policy, which represents $12,408 per year. We can only apply the savings from the 15-year mortgage to the 30-year mortgage for the 15 years. So during that 15-year time frame, that $1,034 is now going to go into this policy. And we want to focus on this column right here, which is total cash value. At the 16th year, there's $273,000 of cash value. The 30-year mortgage homeowner would continue to pay the $2,066 mortgage every month. And at the end of 15 years, they would not put any more money into their high cash value policy. That's what this zero represents. But notice every year thereafter, the cash value continues to grow. At the end of 30 years, when their mortgage is now paid off, they not only have a home that's free and clear, they also have $592,000 of cash value in their policy. And by the way, this money can be used 100% tax-free. They can choose to take retirement income. They could choose to go buy another real estate property or invest elsewhere. Whether a person has a 15-year mortgage or a 30-year mortgage, both homes are going to appreciate. They're going to appreciate the same. It doesn't matter what kind of mortgage or time frame that you have. So yes, you will have equity in the property. But the benefit of the 30-year mortgage and taking that extra $1,034 every month and putting it into the policy only for 15 years allows this person to have $592,000 of cash value that is liquid, that can be used 100% tax-free, and they also have a $998,000 permanent death benefit that they could leave to their beneficiaries. If they do nothing with the cash value or the death benefit and they pass away at the age of 90, there's a $2.3 million tax-free death benefit that would go to their beneficiaries. Or they could choose to take retirement income at the age of 73 or 77, or even at 65 that we had looked at earlier. This cash is liquid. It can be used tax-free. By looking at the benefits of having a 30-year mortgage and putting that extra savings to work in a policy, you're creating more wealth. Many of you will be interested in this. We recommend that you look at your own numbers to see how a high cash value whole life policy will benefit you and your family and allow you to create more wealth throughout your life.